Have you ever sat staring at your trading screen, watching the market go unnervingly still? It's a silence that feels deliberate, heavy with anticipation. It's as if the price itself is holding its breath, waiting for a signal you can't see. Around the world, traders are glued to the same charts. Analysts are dissecting the same headlines, and algorithms are processing the same data feeds. But beneath this surface layer of activity, in a dimension hidden from plain sight, the market is already making its next move. This movement isn't triggered by a breaking news alert or a sudden shift in investor sentiment. It's happening because a silent script is being executed, line by line, deep within the market's order book, dictating exactly where the price must go. If you could freeze a single moment in time and examine it with a precision that retail trading tools simply do and offer, you'd uncover a startling truth. Price doesn't just wander aimlessly. It obeys. Most of us are taught to see the market as a grand negotiation, a constant tug-of-war between buyers and sellers, a dynamic balance of fear and greed, logic and emotion. But in the hidden world beneath the charts, price isn't a debate. It's an output. It's a consequence, a downstream artifact of invisible instructions buried deep within execution algorithms, smart order routers, fragmented liquidity pools, hidden queues, and complex order book microstructures that most traders will never encounter. Think of it this way. The price you see on your chart is like a shadow cast on a wall. The real action, the movement that creates the shadow, is happening in the intricate machinery behind it. It's a world of whispered intentions, of tiny fragments of liquidity, of the quiet displacement of volume that is insignificant on its own but immensely powerful when repeated thousands of times per second. This is the world we are about to step into. A place where the price is scripted long before it appears on your screen. You were never meant to see these moments. The architecture of the market is designed to keep them hidden. The vast majority of traders never do. They spend their careers analyzing candles but never feel the heartbeat underneath them. They rely on technical indicators but fail to understand the incentives that drive order flow. They memorize chart patterns without realizing that hidden execution logic is what bends those patterns into existence. And in doing so, they miss the one fundamental truth that institutional professionals build their entire strategies upon. Markets are not moved by opinions, they are moved by flow. The relentless, directed, and often invisible pressure of orders entering and exiting the market. A single massive iceberg order, carefully placed to lean on available liquidity, can completely redirect the momentum of an entire trading session. A hidden liquidity pool, absorbing wave after wave of selling pressure, can suppress volatility that, by all other measures, should have erupted. A smart order router, intelligently probing dark pools and alternative trading venues, can shift the visible landscape of supply and demand without ever printing a single candle that looks out of place. If you've ever found yourself looking at a chart, utterly bewildered, asking, "Why did the price just do that?" There was no news, no event. Then you've stumbled upon the very question this documentary answers. The movement you witnessed didn't just happen. It began long before you saw the evidence on your screen. It was the final, visible result of a chain reaction that started deep within the market's plumbing. But the real mystery isn't just that these hidden forces exist and shape the price. The more profound question is why they exist at all. Why is a system that facilitates trillions of dollars in daily transactions structured around invisibility? Why do modern markets rely so heavily on microstructure signals that are designed to vanish the instant they are created? And why are the most powerful forces driving price the ones that are never mentioned in finance, textbooks, or discussed on mainstream financial news networks? There is a very clear reason why every major financial institution, from hedge funds to investment banks, invests exponentially more capital into its execution technology than it does into discretionary analysis or hiring star traders. They understand the modern game. In a world where liquidity is fragmented across dozens of different exchanges, dark pools, and private venues, price is no longer just a function of fundamental value or popular opinion. It has become a function of access, speed, and order priority. It's about who can see the order book most clearly, who can react the fastest, and whose orders get to the front of the queue. In this high-stakes environment, your belief about where the market should go is irrelevant if you don't have the technological means to translate that belief into effective execution. Your analysis is worthless if your orders are consistently outmaneuvered by more sophisticated players who are exploiting the very structure of the market itself. In this video, we are opening the playbook that explains why price behaves the way it does, especially in those quiet, confusing moments when the headlines say nothing should be happening. We will pull back the curtain and show you how order flow scripts the market's narrative second by second. We will explore how hidden cues and liquidity fragmentation can reshape the formation of every single candle on your chart. We will uncover why the reality of price discovery is nothing like the simplified story you hear on television. The market isn't a chaotic, unpredictable ocean. It's a highly engineered system with rules, protocols, and hierarchies. The players who understand this system don't just react to the market. They actively participate in its construction. They don't just trade the price, they influence its path. We'll journey into the world of high-frequency trading, but not in the way it's usually portrayed. We'll look beyond the sensationalism of speed and explore the subtle strategies these firms use to manage liquidity and profit from the market as microstructure. We'll dissect the anatomy of a trade, following an order from the moment it's conceived to its final execution, revealing the hidden toll gates and detours it encounters along the way. You'll learn about concepts like order book imbalance, liquidity sweeps, and the cat-and-mouse game played between predatory algorithms and institutional order flow. This isn't about conspiracy. It's about mechanics. It's about understanding the engineering of a system that has evolved to prioritize efficiency and liquidity provision, often in ways that are counterintuitive to the average observer. For anyone who is serious about understanding financial markets, this knowledge is not just interesting, it is foundational. It reframes your entire perspective. Instead of seeing patterns, you begin to see intent. Instead of seeing support and resistance levels as magical lines on a chart, you start to understand them as zones of concentrated liquidity, actively defended or targeted by algorithmic strategies. You will stop asking why the market moved and start asking how it was moved. This shift in perspective is the single greatest leap a trader can make, moving from being a passive observer of price to an active interpreter of flow. It's the difference between watching the shadows on the wall and understanding the machine that casts them. So, I invite you to stay with us until the very end of this documentary. The concepts we're about to explore may challenge everything you thought you knew about trading and market dynamics. It will require you to look beyond the candlestick and see the complex machinery whirring just beneath the surface. But I can promise you this. Once you understand the silent script of the market's microstructure, you will never look at a chart the same way again. The story of how prices are made today doesn't start with algorithms or supercomputers. It starts way back in the late 19th century. Picture this: crowded trading floors, chalkboards everywhere, men in suits shouting, waving hand signals, buried under a mountain of paper tickets. Back then, everyone thought price was a pure act of discovery. It was human negotiation, noise, and raw emotion all boiled down into a single number. But even in those chaotic early days, if you paid close attention, you could see something else at play. Price didn't just reflect what people believed. It reflected who had better access. The traders standing closest to the action in the trading pit heard the orders first. If you were near an influential broker, you saw supply and demand shift before anyone else. This information advantage, even in its most basic form, created what we now call microstructure. The seeds of today's invisible, high-speed markets were sown right there in the dust and noise of those old exchanges, where being physically close meant having power and speed was your destiny. By the early 20th century, things started to change. Telegraph lines connected exchanges across cities, and the ticker tape turned the market's noise into a stream of coded information. But the old belief held on. The public thought prices moved because of company earnings or big economic news. What they didn't see was that the market was already splitting into layers. There was the information that insiders got instantly, and the information that trickled down slowly to everyone else. Even then, the flow of buy and sell orders was quietly shaping prices, but nobody had a name for it yet. The stock market crash of 1929 was the first time this hidden reality really broke through to the surface. While newspapers blamed wild speculation and greed, people inside the system knew something far more mechanical had happened. Hidden pockets of debt had built up, and as insiders quietly pulled their money out, the market's ability to handle trades just thinned out. Prices didn't collapse because opinions suddenly changed. They collapsed because the support system of buyers and sellers, the liquidity, vanished from underneath them. This was the true beginning of modern market theory, though it would take another 50 years for anyone to really start studying it. After 1929, regulators thought making things more transparent would fix the problem. They introduced new rules and reporting requirements. But what good is transparency if you don't understand what you're looking at? The public could see the price, but not the complex plumbing beneath it. They saw the volatility, but not the empty order books that came before it. They saw the crash, but not the fractures in liquidity that caused it. The myth that markets are guided by human opinion survived for another generation simply because nobody knew where else to look. It wasn't until the 1960s and 70s that we started to get the first real theories about how markets truly work. Computers were just beginning to creep onto trading floors. Orders that once needed a phone call could now be sent through early electronic systems. This is when ideas like order priority and quote-driven markets first appeared. Big institutional investors started noticing something strange. When they tried to make a large trade, the market seemed to move against them even before the trade was finished. The price would drift in the direction they wanted to trade. Analysts blamed information leaking out, but the real cause was structural. The market could feel the pressure of a big order like a footprint in the sand long before the public saw any movement. Price became predictive because liquidity was reactive. This was the moment insiders realized the market wasn't a canvas for opinions, it was a sensitive instrument, reacting to pressure long before a trade ever hit the ticker tape. Then came 1987, Black Monday, a day that redefined everything. The public thought the crash was caused by panic selling. But later analysis revealed something much more unsettling. Automated trading systems, early portfolio insurance strategies, and mechanically triggered sell programs all collided at once. This created a massive cascade of selling that completely overwhelmed the market's ability to find buyers. Price collapsed not because of emotion, but because the order books simply could not absorb the flow. For the first time, everyone had to admit that the market's internal structure, its microstructure, could cause a crash all by itself. The ghost of 1987 still haunts the design of every trading algorithm today, a reminder of what happens when automated systems create feedback loops that lead into the abyss. The 1990s brought fragmentation. Instead of one central stock exchange, markets shattered into dozens of competing electronic venues. Suddenly, no one could see the entire market at once. The price you saw on your screen was just an average of dozens of hidden micro-markets. To navigate this maze, smart order routers were invented. These were algorithms designed to find the best place to execute a trade. But they did more than that. They started learning. They probed for liquidity, tested reactions, and identified patterns. Price began reacting not just to supply and demand, but to the behavior of other machines. A chart might show a simple price move, but the real action was a complex dance of algorithms across dozens of venues happening in milliseconds. This was when markets became truly opaque, not because of secrecy, but because of sheer complexity. In response, dark pools emerged. These were private trading venues where big institutions could trade large blocks of stock without revealing their intentions to the public market. They didn't show bids or offers. They didn't signal anything, but they still influenced the market. A huge trade in a dark pool could quietly absorb selling pressure, preventing prices on the public exchanges from falling. Or, if a dark pool was empty, it could force huge orders out into the open, amplifying volatility. The price you saw in the news was increasingly just a reflection of hidden interactions happening in places the public could never see. By the early 2000s, high-frequency trading, or HFT, turned microstructure into the single most dominant force in the market. HFT firms didn't care about a company's long-term value. They cared about microseconds. They built predictive engines that could sense when a large order was about to hit the market or when liquidity was about to shift. They didn't wait for the price to change. They anticipated it. They would literally step in front of slower orders. For the first time, price truly became scripted. It was algorithms on one side reacting to algorithms on the other, creating a feedback loop that determined where the price would go next. The public saw rapid price ticks and just assumed it was a volatile day. Insiders saw clear, deterministic patterns unfolding in real time. The flash crashes of 2010 and 2015 laid bare the fragility of this new system. The public blamed it on a fat finger error, a simple typo. But the real explanation was far more disturbing. A small, initial disruption in order flow caused liquidity to vanish across almost all exchanges simultaneously. The very algorithms designed to protect the market and find the best price ended up chasing phantom liquidity in a destructive loop that accelerated the collapse. Price became completely unhinged from any sense of reality, not because traders panicked, but because the market's internal machinery failed. By the 2020s, the transformation was complete. Modern markets no longer operate as a forum for human beliefs. They are a network of interacting algorithmic systems. The flow of orders, not sentiment, dictates direction. Execution logic, not analysis, shapes volatility. And liquidity, not opinion, determines how far a price can move. The story that markets reflect our collective wisdom survives only because the true system is too complex for a simple headline. But those inside the system understand the hidden truth, that price is scripted by the interaction of fragmented markets, dark pools, routing pathways, and microsecond execution engines. Markets don't move because investors think differently. They move because the structure underneath them shifts. And that is where our journey now turns, into the hidden mechanisms of microstructure itself, the machinery that has quietly replaced every traditional belief about how markets work. Because to understand price today, you have to stop watching the screen and start watching the flow beneath it. For decades, we've been told a simple story about the stock market. News breaks. People react, they buy or sell, and the price moves. But a quiet, unsettling secret that spread through trading floors in the late 2010s. Imagine this. You're an analyst, staring at screens day in and day out. Prices are moving, but there are no big trades, no breaking news, not even a change in the visible orders. It's like the market is psychic. This wasn't just a hunch. It was a realization that fundamentally rewrote the rules of the game. The market wasn't just reacting to orders anymore. It was reacting to the anticipation of orders. Think about it. Price was starting to move before the transaction even happened. It was as if the entire system had developed a nervous twitch, a sixth sense. Tiny, exploratory orders designed to be completely invisible would suddenly cause liquidity to vanish like a startled animal sensing a predator. A trading algorithm just probing a dark pool for opportunities would cause visible prices on public exchanges to shift, even when no trade was executed. The faintest digital footprint of a large institution's intention, scattered across dozens of different venues, was enough to bend the entire trajectory of a stock's price. And that's when it clicked for everyone on the inside. Price was no longer a reaction. It had become a asterisk pre-reaction asterisk. It was a forward-leaning guess shaped by the expectations built into the very machinery of the market itself. This shattered one of the last great illusions, that cause and effect flowed in one direction from an event to a price change. But in the world of high-speed, algorithmic trading, causality started running backward. The price was responding to what the system asterisk expected asterisk to happen, not what had already happened. It wasn't the presence of a big buyer that moved the price anymore. It was the market's asterisk detection asterisk of that buyer's asterisk possible asterisk presence. It wasn't the size of a hidden iceberg order that mattered. It was the subtle pattern of smaller orders being canceled around it that gave the game away. A series of trades in a private dark pool didn't move the market because of their volume. They moved the market because other algorithms saw them, interpreted them as a sign of a larger imbalance, and immediately rerouted their own orders somewhere else. The twist is so subtle but so profound. Prices weren't being shaped by actual trades, but by the interpretation algorithms that were constantly guessing where the next wave of orders might land. The market had become a game of shadows reacting to other shadows, not to substance. You could literally remove the final trade from the equation, and the price would have still moved in the same direction, because the signal had already been absorbed and processed by the system. This was the moment traders realized price was no longer being set by supply and demand in the traditional sense. It was being asterisk predicted asterisk into existence. But the rabbit hole goes deeper, and this is where it gets really unsettling. This predictive reflex wasn't some accidental glitch. It was a necessary feature baked into the very incentives of our modern, fragmented, high-speed markets. Exchanges are in a constant war for business. They compete by offering faster systems, special rules, and fee structures that attract certain types of profitable order flow. In this hyper-competitive environment, being the first to detect incoming pressure gives you a massive, almost unfair, advantage. So, what did the high-frequency trading firms, or HFTs, do? They built sensors. Not physical sensors, but incredibly sophisticated algorithms designed to watch for the microscopic tremors that come just before a real order hits the market. A single order being partially canceled at the wrong nanosecond, a flicker of size in a hidden order book, a slight stutter in the execution of tiny odd-lot trades. These almost invisible distortions became loud, clear signals to the machines. HFT wasn't just reacting anymore. It was inferring. It was making educated guesses based on these faint clues. And so, the price began to shift based on inferences of other inferences. It became a recursive loop of machines reading other machines, of structure responding to structure. While the public and the media still believed that big headlines moved markets, the reality on the inside was that markets were now being moved by the micro-intentions of algorithms reading each other as digital footprints. This explains a phenomenon that has baffled so many. Sometimes, a huge piece of news will drop and the market does nothing. It just sits there. Why? Because the underlying order flow structure, the invisible network of algorithms, wasn't positioned to validate that news. The machines weren't ready to act on it. Conversely, the market can go into a complete tailspin on a perfectly quiet day with zero news. A liquidity vacuum deep inside the system's plumbing could create the illusion of panic. A private dark pool suddenly running dry could spark a fire sale on the public exchanges. A simple miscalculation in a smart routing algorithm could amplify volatility that no human trader ever intended. The shock wasn't just discovering that price could move without news. The real shock was realizing that news now only mattered if the underlying order flow allowed it to matter. The machines had to agree with the headline. And here's the final, mind-bending twist. The big institutions, the pension funds, the mutual funds, the very players trying to be careful, were unintentionally training the system against themselves. Every clever trick they used to hide their large trades, slicing them into tiny pieces, using iceberg orders, randomizing their timing, sweeping through dark pools, all of it was just creating a massive database of behavioral patterns. The smart routers study these patterns. The HFT engines learned to anticipate them. And the liquidity providers began reacting preemptively, pulling their offers before the big order even arrived. The market's architecture was learning, not like a human, not with consciousness, but in a cold, statistical, structural way. The market had become a mirror that didn't reflect the present state of affairs. It reflected the most probable future of order flow. And this means something truly radical has happened. Price has decoupled from human time. While we process information in seconds, minutes, or hours, the market's microstructure processes the asterisk implications asterisk of that information in microseconds. What looks to us like an instantaneous price jump in reaction to a news alert is often just the final, visible conclusion of a movement that actually began long before anyone even refreshed their screen. This is the point where everything you thought you knew about price has to change. The real market doesn't move when you see it move on a chart. It moves earlier quietly, structurally, invisibly. By the time that movement becomes a line on a graph, the underlying script has already been written, directed, and performed in the hidden machinery beneath the surface. The ultimate truth about price isn't that it reacts too quickly for us to keep up. It's that it reacts to things we will never, ever see. And in that hidden world, the future happens before the present. To understand how order flow truly scripts the price. First, let's get one thing straight. The market isn't a single place anymore. It's a vast network. In the U.S. alone, there are over 40 different trading venues, exchanges, electronic communication networks, and the infamous dark pools. In fact, a huge chunk of all trading, over 40% last year, happens off-exchange, away from the public eye. This fragmentation creates a maze. The price you see on your screen, the National Best Bid and Offer, or NBBO, is just a snapshot of the surface. Beneath it lies a hidden world of unseen orders, complex instructions, and secret negotiations that are the real forces moving the market. Think of it like this. When you see a trade print on the tape, you're only seeing the final scene of a long and complicated movie. The story actually begins the moment an order is born, long before it ever reaches an exchange. Most big institutional orders, the ones that can actually move the needle, start their journey inside a sophisticated algorithmic execution engine. These aren't simple order slicers. They are intelligent systems making constant decisions based on where the liquidity is, how long it might take to get an order filled, and how to avoid leaving a footprint. These algorithms might break a huge order into thousands of tiny child orders trying to fly under the radar. But here's the irony. Even these so-called invisible orders leave a signature. High-frequency trading systems, or HFTs, are masters at detecting these subtle patterns in timing and size. It's like a high-stakes game of hide-and-seek, where anticipating the next move becomes the most profitable strategy. The market becomes a reflexive system where everyone is trying to guess what everyone else is about to do. Let's dive deeper into how this actually affects the price you see. Consider something called queue priority. On most exchanges, it's first come, first served. If your order gets in just 1 microsecond faster than someone else's, you're at the front of the line. For popular stocks, the line to buy or sell at a single price can be tens of thousands of shares long. So, the price level you see isn't just a number. It's a layered ecosystem of intent. If a big institutional order joins the back of that long queue, its chances of getting filled are slim. So, what do? Execution algorithms are smart. They know about queue dynamics. They'll often place an order, then cancel it, then place it again, constantly jockeying for a better position. These tiny movements, this constant canceling and reposting, create a flicker in the market's liquidity. For HFT systems, this flicker is a signal, a whisper that a big player is trying to get something done. And even a small 100-share cancellation at just the right moment can be enough to trigger a chain reaction, causing the price to lean in one direction or another, all in anticipation of the flow that's about to come. Now, let's talk about a secret weapon in this game: odd lots. These are orders for less than 100 shares. Under the rules, they don't affect that main price quote, the NBBO. This makes them the perfect tool for probing the market without tipping your hand. And it turns out they're not just a small-time player. Research has shown that over half of all marketable orders in big stocks are executed as odd lots. They've become one of the most important, yet publicly invisible, sources of price discovery. HFT engines are constantly scanning these odd lot prints. They're looking for clues. If they see a surge in buying activity in odd lots, but the main displayed price isn't changing, they infer that there's hidden buying interest lurking beneath the surface. They start adjusting their own quotes, and slowly the price begins to drift upward. Not because of a news headline, but because the secret language of odd lots revealed a shift in the balance of power. And then there are the dark pools. These are private trading venues where big institutions can trade with each other without showing their orders to the public. They typically trade at the midpoint of the public bid and ask price. Dark pools regularly handle about 15 to 20% of all U.S. stock volume. But their influence is much, much bigger. When an algorithm gets a fill in a dark pool, it doesn't see it as random noise. It sees it as a signal proof that someone was willing to trade at that price right now. This information is gold. Smart routing systems immediately use it to shift their strategy. They might pull volume away from the public, lit markets, and send more orders into the dark. This subtle shift reduces the visible liquidity on the public exchanges, which can cause the price to move without any obvious catalyst. To the outside world, it looks like a quiet, unexplainable drift. But in the world of microstructure, it's a direct result of a rebalancing of hidden liquidity. This effect becomes even more dramatic during times of market stress. During the volatility of March 2020, for example, the difference between buy and sell prices on public exchanges widened dramatically. But in dark pools, things were much calmer. So, where do you think the big algorithms sent their orders? They flooded into the dark venues, leaving the public order books thin, volatile, and reactive. The price movements we saw during that time often seemed completely detached from the news, because the real driver wasn't information, it was a severe imbalance in the market's internal plumbing. Finally, all of this is supercharged by speed. We're talking about microseconds, millionths of a second. The fastest firms pay to place their computer servers right inside the exchange's data centers. This is called colocation. Studies have shown that a speed advantage of just 4 or 5 microseconds can dramatically improve your chances of getting a trade filled. This creates a feedback loop. The fastest firms see the flow first, they reposition their orders first, and they influence the price first. By the time a slower participant, like a retail trader or even a slower institution, decides to place an order, they're already stepping into a market that has been shaped and sculpted by these lightning-fast interactions. The price doesn't move towards their order. It has already moved around it before they even click the submit button. The public sees a sudden price jump and blames it on emotion or some rumored news. But the microstructure expert sees the logical, inevitable consequence of speed, fragmented liquidity, and the hidden games being played every single second. This parent order is too big to execute at once. It would send the price soaring. So it gets broken down into thousands of smaller child orders. The job of routing these tiny orders falls to a smart order router, or SOR. Think of an SOR as the silent conductor of the market. Within microseconds, it decides where to send each child order based on price, size, speed, and the probability of getting filled. It's a complex calculation, but here's the kicker. This routing isn't neutral. When an SOR repeatedly sends orders to a specific exchange, it changes the liquidity on that exchange. The visible supply of shares might temporarily shrink. This alerts high-frequency trading firms, or HFTs, who instantly adjust their own quotes. This single adjustment echoes across dozens of other exchanges, triggering a domino effect of quote updates. Suddenly, the national best bid and offer, the NBBO, which is the price you see, has shifted. The original institutional order never even touched the public market directly, but its routing footprint moved the price for everyone. Price becomes an emergent property of routing decisions, not fundamental information. Now, let's add another layer, pegged orders. These are orders that automatically adjust their price to follow the NBBO, often staying at the midpoint between the best bid and ask. In 2022, NASDAQ reported that pegged orders made up a huge portion of liquidity in popular stocks. So, what happens when our routing decision from earlier causes a tiny shift in the NBBO? All those pegged orders instantly reposition themselves. This creates a chain reaction. A single subtle event can cause a cascade that thins out liquidity at one price level and thickens it at another, creating the illusion of sudden momentum. A retail trader might see a breakout, but a microstructure expert sees a simple realignment of pegged liquidity. During volatile times, this effect gets amplified. SEC data from 2021 showed that during wild market swings, this repositioning of pegged orders could account for up to 40% of all quote updates in certain stocks. This is the skeleton moving the market while the public is just watching the candles on the chart. Then we have what are known as liquidity holes. These are gaps in the order book where there is very little or no volume available to trade. They don't happen randomly. They're created by structural forces like fragmented routing or activity shifting into dark pools. When a trading algorithm detects a liquidity hole, it might react aggressively, trying to execute a trade before the hole gets wider. This action itself becomes a signal, prompting other algorithms to pile on. The result? A sharp, sudden price move with absolutely no news behind it. A classic example was the 2015 ETF mini crash. Highly liquid ETFs suddenly tanked because market makers all pulled their quotes at the same time. This created massive microstructure holes faster than routing systems could adapt. The crash wasn't caused by investor panic. It was caused by a structural breakdown of liquidity interacting with automated trading logic, and it gets even deeper. A huge amount of liquidity is completely invisible to the public. These are called hidden orders, like reserve or iceberg orders. An iceberg order, for example, might be for 100,000 shares, but it only shows 1,000 shares at a time. However, HFTs are masters at detecting patterns. They notice when that 1,000 share block gets filled and is instantly replaced by another 1,000 shares. They can infer the existence of a huge hidden order with stunning accuracy. Once detected, the market starts to react as if the full 100,000 shares were visible. Spreads might widen, and other traders might rush to execute before they get crowded out. The price starts to lean in one direction long before the full order is even filled, simply because the underlying structure is already responding to what it knows is there. Another key piece of this puzzle is latency arbitrage. This is where ultra-fast firms take advantage of microscopic delays in data transmission. They might see a price change on one exchange a few microseconds before a slower participant on another exchange sees it. They can then trade against that slower participant's stale liquid for a risk-free profit. Now, the profit itself isn't the point. The structural consequence is, when a fast firm hits a stale quote, it forces that venue to update its price. This update then triggers adjustments across all other linked venues. So, what looks like a sudden price jump might just be a synchronization event, the entire fragmented market catching up to itself, all kicked off by a latency difference smaller than the blink of an eye. You see a breakout. Microstructure sees a temporal alignment of fragmented order books. These mechanisms become incredibly powerful during times of market stress. Take the U.S. Treasury market in March 2020. This is supposed to be the most liquid market in the world, but it experienced severe dislocations. Spreads between buying and selling prices exploded. The amount of available treasuries to trade collapsed by up to 90% for the 10-year note on some platforms. This wasn't caused by waves of panic selling. It was a plumbing issue. Market makers withdrew, leveraged trades blew up, and algorithms malfunctioned. The system's capacity to absorb orders was crippled. This created massive price swings that had very little to do with the economic outlook. Price became a function of plumbing stress, not recession fears. We see the same thing in the foreign exchange market, where over $7 trillion trade every day, mostly by algorithms. Here, order flow itself often predicts currency movements better than economic news. A famous case was the Japanese yen flash rally in January 2019. The yen surged violently in minutes. At first, everyone blamed geopolitical fears. But later analysis showed the real cause. The move started in thin holiday trading conditions, was amplified by a cascade of automated stop-loss orders, and accelerated by algorithms detecting liquidity holes. The yen didn't strengthen because global sentiment changed. It strengthened because the market's internal structure made the path of least resistance upward. Finally, every institutional trading system uses what are called market impact models. These models predict how much a large order will move the price. There are famous formulas like the Almgren-Kris model that are surprisingly good at this. They know that price impact tends to grow with the square root of an order G size relative to daily volume. This creates a predictable relationship between order flow and price predictable for algorithms, that is. So when an execution algorithm is about to place a large order, its own impact model tells it, hey, this order is going to move the price against you. What does the algorithm do? It adjusts its strategy preemptively. This means the price can start to move before the order even begins to execute. The market is literally reacting to the future footprint of an order that hasn't happened yet. Anticipation gets baked into the price itself. So, when you put it all together, the fragmented venues, the invisible liquidity, the pegged order cascades, the latency games, the liquidity holes, and the predictive impact models, you arrive at a fundamental truth. Price is scripted by structure. When the structure changes, the price changes. When flow is anticipated, the price reacts. When liquidity is imbalanced, the price drifts. In the world of microstructure, nothing is random. Every tick has a structural cause, even if it's invisible to the naked eye. This is the architecture beneath every chart you see. This is the system the public never gets to watch. And this is why, so often, the price moves when it feels like nothing should be happening. The truth isn't in the news. It's in the pipes. The most unsettling truth, whispered among those who've peered deep into the market's core, is that price now belongs to the architecture. Every single candle on your chart, every breakout you chase, every dip you buy, it's just a surface reflection. It's the final scene of a play whose script was written long before the curtain rose. Beneath what you see, there's a hidden world of microstructure, a complex web of algorithms, high-frequency traders, and automated systems. We talk about the market reacting as if it has feelings. It doesn't. Price is just a consequence of what the machines are doing, and what do these machines care about? Not your trend lines. Not the latest headline. They care about structure, incentives, and the flow of orders. They hunt for tiny imbalances, they manage queues, they exploit timing advantages down to the microsecond. These signals are invisible to the human eye, appearing and vanishing in the blink of an eye. This is the quiet reality of modern markets. They aren't chaotic. They're choreographed. They aren't free. They're constrained by a complex underlying script. Think about it. The more fragmented our markets become, with dozens of exchanges and dark pools, the more tightly price is bound to this hidden script. Before you even see the first tick of a new candle, its fate is already being shaped by the flow of information through this invisible architecture. Now, this might sound fatalistic, like we have no control, but it's not meant to discourage you. It's meant to clarify. Once you accept that the real market operates beneath your feet, not in front of your eyes, everything changes. The world becomes sharper. Movements that once seemed random start to feel inevitable. A sudden flash crash that felt like panic now looks purely mechanical. What seemed like a conspiracy is revealed to be just a structural necessity of the system. You start to see the gears turning behind the curtain. But this clarity comes with a serious warning. The more complex this system gets, the more fragile it becomes. Every layer of hidden liquidity, every microsecond gained in the latency arms race, every dark pool transaction, it all adds efficiency, but it strips away resilience. The system is optimized for speed, but it becomes incredibly brittle under stress. It's like building a race car with the thinnest possible frame. It's fast, but one wrong bump and it shatters. A crash no longer needs widespread panic. All it takes is a small tear in the fabric of the architecture. A single liquidity hole in the wrong place, a routing algorithm that makes a wrong turn, a brief, synchronized pause by market makers across different venues. These small glitches can cascade outward, creating massive price swings that affect assets with no logical connection to the original problem. Modern markets don't fall apart because of fear. They fall apart because their underlying structure loses coherence. And here's the kicker. You were never meant to see any of this. The microstructure was designed to be invisible. Exchanges don't advertise the fragility of their matching engines. Your broker doesn't explain how their smart order router is sniffing out liquidity. Big institutions don't tell you how they're rehiding their massive orders in dark pools and slicing them into odd lots. The public only ever sees the final printed price. You never see the storm of signals, the near misses, and the frantic rerouting that happened just milliseconds before. But the more invisible the system becomes, the more vital it is to understand what's happening in the shadows. Because the next major liquidity event, and trust me, it will come, won't announce itself on the news. It won't be in a headline or a tweet. It will reveal itself first in those unseen places. You'll see it in shrinking queue depths at major exchanges, in the internal spreads of market makers widening, in pegged orders becoming misaligned, and in dark pools suddenly absorbing or withholding massive amounts of flow without any warning. By the time you see that first violent candle printed on your chart, the event is already in full swing. The game is already over for anyone who was just watching the screen. The outcome was decided minutes or even seconds before. So, as we wrap this up, I want you to remember the one truth that connects every part of this hidden world. Markets do not move on their own. They are moved. They are moved not by sentiment or stories, but by structure. Not by belief, but by the flow of orders. The deeper you look into that structure, the clearer it becomes that the market S-surface is just an echo of the powerful mechanisms churning beneath it. If you truly want to understand where the price is going, you have to stop watching the screen and start watching the architecture. The script is always written before the candle begins to form. The market always whispers its intentions before it speaks aloud. You were never supposed to see this hidden world, but now that you have, the shadows will never look the same again.